Quit Like a Millionaire, No Gimmicks, Luck, or Trust Fund Required by Christie, Shen and Leung is a financial independence book that details how the authors went from poverty to early retirement in their 30s. Their story is not about traditional paths to wealth or relying on luck. Instead, they focus on actionable strategies that anyone can follow to achieve financial independence and retire early. Through practical advice, the authors outline how to save, invest, and live a life of freedom. This summary covers the key lessons from Quit Like a Millionaire in 1,000 words. Introduction: The power of financial independence. Christie Shen begins by sharing her personal story of growing up in poverty in rural China and moving to Canada, where she witnessed financial inequality firsthand. These experiences gave her a strong motivation to avoid poverty and achieve financial independence. Shen and her husband, Leung, realized early on that the traditional path of working until retirement wasn't for them. They discovered the FIRE movement, which allowed them to achieve early retirement through frugal living, aggressive saving, and smart investing. The book is broken into 3 parts: Why Quit, How to Quit, and How to Stay Retired. Each section focuses on a different stage of achieving and maintaining financial independence. Part 1. Why Quit. The first part of the book addresses the mindset needed to achieve financial independence and why one should aim for it. Escape the rat race. Shen explains that most people are stuck in the rat race, working to earn money, spending what they earn, and never breaking free from the cycle. Society tells us that the way to wealth is through a high-paying job, climbing the corporate ladder, and working until you're 65. However, Shen and Leung challenge this belief by showing that financial independence doesn't require high income or extreme frugality. It's about making smart financial decisions. The value of money. Shen emphasizes the importance of understanding the value of money. She introduces the concept of marginal utility, which suggests that each additional dollar provides diminishing returns in terms of happiness and satisfaction. For example, while earning your first $30,000 might bring substantial happiness, providing food, shelter, and security won't provide 10 times more happiness. Understanding this principle helps people realize that spending more money doesn't necessarily equate to a better life, leading to smarter spending habits. Part 2. How to Quit. This section focuses on the practical strategies and steps required to achieve financial independence. 1. Cutting expenses and maximizing savings. The first and most crucial step toward financial independence is aggressive saving. Shen and Leung followed a savings rate that allowed them to invest a significant portion of their income. The authors suggest aiming for a savings rate of at least 50% of your income, if possible. To achieve this, they focus on cutting major expenses like housing, food, and transportation, which are the biggest costs for most people. Instead of advocating for extreme frugality, Shen stresses the importance of spending efficiently. For example, they recommend geographic arbitrage, where you live in a low-cost area while earning a higher income, to maximize savings potential. 2. The 4% rule and the safe withdrawal rate. One of the key principles of early retirement is understanding how much money is needed to retire. Shen and Leung used the 4% rule, a widely accepted rule in the FIRE community that states you can safely withdraw 4% of your investment portfolio each year without running out of money. This means that to retire, you need to save 25 times your annual living expenses, since E divided by Cis is Wu. For example, if your yearly expenses are $40,000, you would need to save $1 million to retire comfortably and sustain your lifestyle indefinitely. 3. Investing in index funds. Shen and Leung advocate for investing in low-cost index funds, which provide exposure to a broad section of the stock market. Unlike stock picking or relying on actively managed funds, index funds are simple, low-risk, and historically generate steady returns over the long term. By consistently investing in index funds over time, The authors were able to grow their wealth significantly. They also discussed the importance of diversification, which minimizes risk by spreading investments across different asset classes like stocks, bonds, and international markets. A well-diversified portfolio ensures that if one market sector performs poorly, others may balance out the losses. 4. Tax efficiency and geographic arbitrage. Shen and Leung recommend minimizing taxes to preserve as much wealth as possible. This can be done by investing in tax-advantaged accounts like retirement accounts, IRA, etc., and choosing investments that produce lower tax liabilities, such as dividend-paying stocks or tax-efficient index funds. In addition to tax efficiency, the authors emphasize geographic arbitrage as a powerful tool for early retirees. By living in countries or regions where the cost of living is low, like Southeast Asia, one can stretch their retirement savings further without sacrificing quality of life. 5. Avoiding lifestyle inflation. As people earn more, they often spend more, a phenomenon called lifestyle inflation. Shen warns against this, explaining that one of the keys to achieving financial independence is to resist the temptation to upgrade your lifestyle with each raise or bonus. Keeping expenses consistent while increasing your income allows you to save more aggressively and reach your financial goals faster. Part 3. How to stay retired. This section explores how to maintain financial independence and live a fulfilling life after retiring early. 1. Handling market volatility. One of the biggest concerns for early retirees is how to survive market downturns. Shen and Leung stress that a well-diversified portfolio, combined with the safe withdrawal rate, can weather most market storms. They advocate for keeping a portion of your portfolio in bonds or other safer investments to draw from during bear markets, while allowing your stocks time to recover. They also suggest having a cash cushion, a few years' worth of living expenses in a savings account or low-risk investments, to provide peace of mind during volatile times. 2. Health insurance and healthcare costs. Healthcare is a major concern for early retirees, particularly in countries like the United States, where healthcare can be prohibitively expensive. The authors recommend researching healthcare options, such as Affordable Care Act plans or global health insurance for those who travel or live abroad. For people considering geographic arbitrage, moving to a country with low quality healthcare can significantly reduce this expense. 3. Purpose and happiness in retirement. Shen and Leung emphasize that early retirement is not just about having enough money to quit your job. It's about living a life that brings purpose and happiness. They challenge the traditional notion that work is the only source of fulfillment and argue that financial independence allows you to choose how you spend your time, whether it's travel, volunteering, hobbies, or passion projects. Early retirement provides the freedom to pursue what truly matters. 4. The importance of flexibility. The authors stress that maintaining flexibility in both lifestyle and spending habits is crucial for staying financially independent. In uncertain economic times, or if unexpected expenses arise, being able to adapt by cutting costs or adjusting withdrawal rates can prevent financial difficulties. Conclusion: anyone can retire early. Quit Like a Millionaire teaches that financial independence is achievable for anyone, regardless of their income level or background, by living frugally, investing wisely, and making conscious financial decisions. Shen and Leung were able to retire in their 30s. Their story serves as a blueprint for readers who want to break free from the traditional work-life path and live life on their own terms. The book emphasizes that wealth is not about how much you earn, but how you manage what you have, with discipline, planning, and a focus on long-term financial goals. Anyone can quit like a millionaire.